Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And welcome back to Navigating Retirement. Here we are, and it's right around the corner here that it's time to file our taxes. Thanks for joining us today. Join us each and every opportunity that you have on demand, anytime you want. Click on our links and join us here on Navigating Retirement. We used to be on the radio where you had to tune in at a certain time. Now we're available 24/7. Anytime you feel that you want to learn a little bit about how you can set up your Navigating Retirement plan, you can visit us on our website, cfpgroup.biz, click on links for our podcast, past podcasts. You can click on links that'll show up on your screen today and opportunities for you to hit the buttons and get information today. We're going to have some articles for you today. And you can always like us on Facebook, or also you can join us and ask us to connect on LinkedIn, either through Rick Durkee or the Coastal Financial Planning Group. So without further pause, let's get into some last minute tax moves that we can do here before we file those tax returns. Here's our subject today that we want to talk about. It's saving as much as we can and paying as little as we can in taxes. We want to avoid taxes wherever we can. We don't want to evade them. We don't want to get in trouble with the IRS, but we know that we can control our tax bills by doing some proactive planning and avoid taxes wherever we can to save in that bottom line. You know, we know taxes are going to be our biggest expense in retirement, right? We're one of them. Okay. They're going to be taxed on those 401ks and IRAs. Wouldn't it make sense to do some planning, some proactive planning where we reduce that tax bill or that expense? Today, we're going to talk some strategy, some last minute tax moves to consider that can substantially lower your tax bill. Let's make some smart financial moves today. I want to talk to you about one thing here really quick, and it's one of the keys to paying the least amount as possible in this year and all the years to come when it comes to paying taxes. Hey, we should all understand that the tax system itself, other than we all think, of course, it's broken, it is about your own personal tax situation. We need to make sure that we're focused on that fact. Hey, everybody's tax situation is different. Everybody's income plans are different in retirement. So you need to have at least a base level understanding of how taxes work in order to make informed financial decisions when it comes to income tax planning. So as always, whenever we're talking about tax planning, I need to say that everybody's situation is individual, and you should always consult with your individual tax planner, tax advisor, to see how these ideas that we share with you today may fit into your plan. The number one point I want you to understand is that we have a progressive tax system. If you're middle to upper class, you probably fall into a category or to some extent where you're considered wealthy and you pay a little bit more in taxes. The higher your income, the higher percentage you pay. Single filers typically pay tax rates anywhere in the 10, 12, 22%, but they can go as high as 24, 32, 35, or 37. Married filers have the same tax rate. They also have the same taxable income brackets. They start out, and I'm not going to go through this whole table, but you can click on the button here and we can send you a copy of this tax table today. We'll send that right out to you. But if we're looking at single filers and the taxable income brackets and tax rates as they relate to dollars, in single filers, you're looking at $0 to $9,875, where we're at 10% of taxable income becomes taxed at your ordinary income tax rate. Those numbers double if you are a joint filer. The second bracket, 12%, $9,876 to $40,125. These numbers double for double filers. It's as simple as I can make it here, and it goes all the way down the list here. Again, click on the link here and we'll send you out this tax table. But we cannot stress how important it is that you understand that this is a progressive tax system. So those numbers that I just gave you, you get taxed on 10% of the first 0 to 9,875 if you're a single filer, but anything over that 9,875 jumps up to the next level at 12%, and then it just stair steps from that point based on this table. That's important information to know when we're doing tax forward planning and we're looking at our income streams and how much income we want to take, especially in retirement. Understanding how these brackets work and where you fall into them is essential in making smart and sound financial tax decisions. Next point, it's important to know where you do fall now, but what about where you're going to be in retirement? From a proactive planning perspective, another key element is accurately predicting where you're going to be in the future. You can do that easily with some retirement income planning and looking at where your streams of income are going to come to you in retirement. If you're able to make some smart moves now to eliminate income taxes later, then we certainly are doing some proactive planning. This should be considered in your tax planning, doing proactive planning. Let me give you an example here. A big expense is our mortgage payment, right? Paying with our IRA in retirement, which is fully taxed income, might not be a smart move. So that's why you see so many people eliminating that mortgage payment in retirement. If all we've done is saved in our IRAs and we've got to pay ordinary income taxes on that money to pay down our mortgage, I mean, you could be paying an extra interest or debt to the IRS of 10, 12, 22% that I mentioned earlier. And that's significant when that adds up, that you're paying taxes on those withdrawals out of that IRA. If we have some other sources of income that are tax favored or tax free, wouldn't that be a better idea? Or, hey, what if you eliminate that mortgage payment in retirement and you don't have to make it anymore? Now we don't have to do withdrawals out of those IRAs or anything and pay taxes on them. So the success of your lifelong tax strategies lay in how accurately you can make and stick to your retirement income plan. Hey, think about this. The only thing constant in life is change. And when it comes to tax planning, the rules change all the time, right? Congress votes on this, new administration comes in, new taxes here that weren't there before. You know, the only thing constant in life is change. And when it comes to tax rules, they're going to change. It's certain that they're going to change going forward. So let's do some proactive planning when it comes to that. When it comes to retirement, though, the tax code is written in pencil. The most recent example of that is the Secure Act. It changed everything when it came to our legacy planning in retirement when it comes to taxation of your IRAs. So know that when we do our planning and we do some proactive planning, that we're protecting ourselves from those future changes. Because oftentimes when it comes to tax rules are grandfathering people that made those decisions now to save money later. They're okay. It's the people that didn't make the changes that are going to get in trouble. So, hey, pay me once, shame on you if it's pay me twice. The joke's going to be on you, right? Let's do some proactive planning and let's make sure that we've done some of that tax planning that we've discussed in these past prior 2 episodes. And we'll talk about today again a little bit more. And we'll talk about in our next episode on tax planning for retirement. Remember in those first 2 episodes, I brought up bucket planning, tax buckets, and how easy it is to classify your savings as tax now, tax later, and tax never. These 3 buckets always deserve consideration whenever we're doing any kind of tax planning. Anytime there's conversation about taxes, let's make sure that we're looking at the 3 buckets. And remember, we had 3 classifications of income. You remember active income, or from our paychecks, then investment income, like from our IRAs, and then also passive income, or income that comes to us from money that we've reinvested and we've taken out of those IRAs, but we got that money working for us. It's creating little dollars here that add up and create more retirement assets, legacy assets, or perhaps some more income for us in retirement. So that's active income, investment income, and passive income. All 3 of those are taxed differently. We want to do some proactive planning in those areas also. Here's something that I can let you go home with today and say, hey, it was a benefit for spending these 10 minutes with Rick and navigating retirement. Here's some last minute tax strategies. So let's make sure that we're making estimated payments along the way so we don't have a big tax bill come due at tax time. Let's update your withholdings. Let's do some ongoing contributions and contribute a little bit more differently maybe into our retirement plans. Hey, you self-employed, let's make sure that we're doing some extra savings in those different plans that are available to the self-employed that give us a little bit more opportunity to build some more wealth in those retirement accounts. Consider doubling up. Mentioned this in a prior episode here on tax planning. You can make 2 years worth of contributions sometimes. You can also make spousal contributions. If your spouse isn't working, you can make contributions on her behalf, or if you're a female working, you could make contributions on a male spouse on their behalf if they're staying at home, or maybe they're out of work due to COVID or something like that. So there's opportunities here to help a spouse still make contributions. We can fund education. We can harvest tax losses by selling the loser stocks in our portfolios that have included what we call individual accounts or joint accounts. We can take those that are after-tax dollars that go into those investments, those losers, and we can sell them. And then we can maybe sell some gainers too at the same time to offset the taxes with our losers. So that's tax loss harvesting. We got HSA accounts, we got FSA accounts, we got conversions where we can maximize your bracketing that I mentioned earlier, using your return, prepay some taxes now on your IRAs so that we can pay taxes never in the future. Remember that bucket number 3, never taxes. Okay, Roth conversions. Remember, life insurance cash values are tax-free if used properly. Qualified charitable contributions, and make sure you're watching out for AMT for some of those higher earners, and make sure that you're doing proper tax planning. Remember, always consult with your tax professional regarding your individual situation. Click on the screen for a copy of this list. I know I went through them quick. There's opportunity here for you to get this list of these last minute tax moves to make. And I got one other bonus for you today. There's an article printed by Kiplinger recently. Actually, it was online, and we'll make that available to you. It's called 11 Money Moves to Make. Now, we don't have the time to go over the 11 money moves today, but I guarantee you, if you click on the button here on the screen, we'll send it right to you. And then if you want to follow up and give us a call at 843-735-5065, we'll talk about one of those 11 moves, or maybe several of them if you find them of interest to you, that can help you save money on taxes now and in the future. In summary, over a lifetime, and especially in retirement, those taxes are big expenses, okay? And savvy planners look for ways to control their taxes. At the Coastal Financial Planning Group, we'll always make this offer to you. We help savers, investors, and everyone else that we've come into contact with over the years here on radio and our podcasting to better determine their outcome and make their goals a reality. At the CFPG, I always use that acronym a little bit for Coastal Financial Planning Group. We help savers like you to help save money on their taxes now so they have more to spend in retirement. If you'd like to learn more about how to retire, how to pay less in taxes, how to keep more of your money, call now, 843-735-5065. A 15-minute phone consult might be right up your alley. And make sure that you request that we sit down and provide you with our Navigating Retirement Plan. That Navigating Retirement Plan has helped many savers and investors to proactively plan for their retirement. So take advantage of our offer. It's always free. Call us, 843-735-5065. Get the Navigating Retirement Plan in your hands, that written retirement income plan, and make sure that you improve your outlook on 2021 and beyond. Thanks for joining us today. Hey, join us again in the next episode. I've got even some better information on specifically how to save some taxes in the future. Thanks for joining us on Navigating Retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospects will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.